This episode of Bulletproof Cash Flow is brought to you by Realty Dynamics. Learn how people like you can build substantial passive income while creating wealth for the long term through real estate investing. Visit rdyne.com. That's RDYNE.com.
It's a good idea to be partnered with somebody that just checks all those boxes. And the boxes really, there are some hard boxes, like they have the net worth greater than 100% of the loan amount. Do they have the liquidity on paper? Those are just check the boxes that are math. The ones that are track record, listen, there's a piece of paper, whether you go through StackSource or you go through a broker, eventually there's going to be a piece of paper that is presented to a credit committee that's never met you. And they're going to have bullet points on that piece of paper. And some of them are going to be, does the math check? Does the math check? Does the math check? Great. And then there's going to be, what is your track record? And there needs to be 1-2 sentences of really strong track record. And you don't want that to be weak.
Working because you want to, not because you have to, is financial freedom. And we want to help you create that. Welcome to the Bulletproof Cash Flow Show. We're going to teach you how to achieve lifetime financial freedom through real estate investment. Your host is a multifamily syndicator and property developer. He's done deals reaching into the hundreds of millions of dollars. You'll hear from experts in all aspects of real estate investment, finance, development, and management. Everything you need is right here. This is the Bulletproof Cash Flow Show. And this is your host, Augustino Pintus.
Quick question. How'd you find this show? Maybe a tweet or an Instagram post? Well, no ads here. Just a small favor to ask. If someone introduced you to this podcast, pass it on. Share, review, tell a friend. It means the world to me. Thanks a ton. Hey everyone, it's Augustino. Your financing team is one of the most important team members you can possibly have. Now, these are the people that line up the debt, maybe even equity for your deals. Like any team member, finding the right ones can be tricky. Now, our next guest knows all about this and has worked on a solution for it. Now, years ago, he identified a market opportunity for a tech-enabled commercial real estate financing platform, and he recruited an experienced team of technologists and real estate financial professionals. To that end, he co-founded StackSource, which is an online platform for commercial real estate loans. Now, StackSource is one of the fastest growing commercial financing companies in the country. Prior to StackSource, he worked for tech giants like Facebook and Google, where he helped expand their overall online advertising platform as well. So with all that, I'd like to welcome Tim Milazzo to the show. Tim, buddy, thanks for coming on, man.
Yeah, Agostino, really good to see you. Thank you so much.
You bet, you bet. Now, guys, if you like what Tim has to say, you can reach him via the contact page at stacksource.com. Okay, Tim, go ahead and tell the listeners a little bit about your journey. How'd you get started in all this?
Yeah, so thanks so much for having me again. I grew up in New Jersey, outside of New York City, and my dad was a broker taking the train into the city. And I would hear about real estate at the dinner table growing up, and these landlords and office leases and all this interesting stuff. And when I was studying finance in college, I interned for a couple of major finance and real estate companies. And I was frankly pretty shocked at how manual the work was in a cubicle and making calls and helping these brokers succeed. And I started looking for real estate tech solutions while I was still in college. Like, hey, how are we in this era of early cell phones and the iPhone was out? And how are we so reliant on phone calls and paper in the real estate industry? And I started looking out for real estate tech. But I worked for tech companies for several years and didn't get into real estate tech until I had had several years of experience in advertising. But I ultimately saw the opportunity for financing to become more transparent. Financing is the biggest contingency in getting an investment deal done. It's usually the majority of capital is coming from a loan. And now this platform, after a few years of building, we're not just loans. We're not just a lender matching marketplace like we first talked a couple of years ago. We're putting together complex debt and equity stuff through our platform and with an expert team of capital advisors. And so it's been quite a journey.
Yep. Yeah. Well, I do remember years ago when you guys first came out. Yeah, it was a very cookie cutter type scenario where there's only certain types of deals you can possibly put into the system. And then, of course, have banks bid on it. or their lenders rather, and then throw out their LOI, so to speak, their term sheets. But I think, yes, I mean, we're working with some of your folks right now, and very, very complicated deals. So it seems that StackSource has obviously become way more than just your cookie cutter type scenarios where you're able to handle very complex and complicated type of transactions, right?
Yeah, you start a company and you think you know what it's going to become. And so when I started StackSource with a couple of software engineers and we built a prototype for lender matching, honestly, that was of value to a lot of small, inexperienced multifamily and commercial real estate investors getting into their first few deals, figuring out what lender they were going to work with and getting competitive bids. As we started hiring capital advisors onto the team, we found out that the primary benefit of our platform was really for capital advisors to provide really great, transparent service to larger investors. And so that's really the way our platform has shifted over the last couple of years. Our average transaction size has tripled. Our marketplace has multiplied since then. And today, 80% of our business comes from deals with some level of complexity. So the level of complexity can be a big value add play where you're basing the underwriting on projected rents and projected finances rather than in place finances. It could be construction, or it could be multiple tranches of capital placed on the same transaction. So senior and mezz debt, senior and pref equity, C-PACE or tax credits, where there are multiple pieces moving in the capital stack. It's a lot more intense to close a deal like that. And the transparency and the efficiency is really what helps that to happen. And the technology is as much for our own capital advisors as it is for the client, and showing them what's happening. And so it's been interesting to see that 80% of our business is complex deals versus what I would have predicted in early stages.
Yeah, well, let's talk about the 80% for a second, because many of the folks that you have on your team, and I'm working with some of these guys right now. It almost seems like they have a very, I guess you can say, a very tight connection to those types of sources. Like they can source the equity as well in some cases. And I'm not saying everybody jump on the phone right now and call up StackSource and to source all your equity. Don't do that.
Yeah.
Unless, of course, Tim says so. But I would say that in certain cases they can get their hands on certain things. But do you find that has a lot more to do with the individual or with StackSource? Like, where do you draw that line? Like, how do you find those sorts of guys to actually come on board and bring them on the team there?
We have some amazing capital advisors on the team that have 30 years of industry experience. They have the energy, they have the connections. We're underwriting the deals well, and that's all very human. The further you go up the capital stack, so at the bottom of the stack, and it may be 60 to 80% of the capital, depending on the transaction, you have the debt. Further up the capital stack, you have the sponsor. And so when I say further up the capital stack, whether it's mezz or pref or all the way up to co-GP equity, where we're bringing you an equity partner, it gets more relationship based because they want to hear that not only are the numbers that are projected are sound and in line with market comps, they want to know, who is this operator? And are they worthy of this relationship where we're funneling millions, tens of millions of dollars of capital, of equity capital? It's the highest risk tranche. The further you go towards equity, it's the highest reward as well. But you have to know you're working with a solid operator and solid people all the way around. So is it the capital advisor or is the firm? We find that it is bringing in the right capital advisors and enabling them to do the right work. It takes every single one of the capital advisors at StackSource to build that reputation, and it could take just one of them to tear it down. And so we've been very careful about vetting deals, and we take vetting very seriously when we're going out for equity capital. Now, we're not syndicating. I don't want to get confused with crowdfunding here, where here are 400 individuals that put in an average of $1,000 to bring in the equity. These are either family offices or small institutions or private equity companies that can come in with one check for pref equity, for co-GP equity, somebody that's going to partner with you on a deal. That's our sweet spot. On the equity side, it's not syndicating to thousands of investors. And there are good crowdfunding portals out there where you can do that. That's not us. But yeah, it's a reputation and a relationship that takes everyone to build it, and it could be taken down in a second.
Oh yeah, 100%. We were talking about that in the green room. It's like I said earlier in the intro, you guys like you guys are really a key aspect of how syndicators like us and deal makers like us put these deals together. And if someone on the team drops the ball, like as far as the debt is concerned, or the equity, or both, I mean, it could put the whole deal in jeopardy. Then that means that I have to go walk hat in hand to the seller of an asset I might be buying and try to negotiate something. And it might end up costing me hundreds of thousands of dollars in extra earnest money, or even an increase in purchase price, because someone screwed up or someone took on the wrong debt or the wrong equity, or whatever the case may be, or they just failed, right? And yeah, it's a big deal. It really is. It really is. So yeah, finding the right partners in your case too is very important when you're underwriting those guys that are saying they can do the deal, right? You have to, like, you guys are doing the underwriting to make sure that they say they can do what they say they're doing, right?
Absolutely. I mean, you can have numbers on a page, but understanding. So the track record thing goes both ways, right? Because as an operator, have you owned something like this before? Have you completed this business plan? Those are the questions you're going to start to get if the numbers work out from an equity partner. And I think a big piece of advice that not everybody gets as a syndicator turning to, for the first time, like, private equity and family office, you should be asking those same questions right back at your equity partner, right? Because if this is a partnership, you want to understand their track record. What other sponsors have they worked with? And then really understanding, have they executed? Have they lived up to their side of the bargain on these other transactions? It becomes like a little bit of a capital dating relationship. You want to see how it feels. You want to see what they've done in the past. And, that relationship really goes both ways.
100%. Now let's talk about the 20% now. So the 80% obviously is the more complicated deals. You have those advisors that really understand how to put those complex deals together. On the other side, I think you mentioned was 5 to 25 units of multifamily. Your automated system is still in play. It's still used today and still provides some value to those folks looking for those sorts of deals. Is that right?
Yeah, absolutely. And for every deal on our platform, you get a dashboard of, here are the capital relationships and the status. This one's under review. That one's quoted you. Here you can compare your quotes. And that's valid everywhere. We find that especially small investors they're really starting in the portal. They love to be clicking the buttons and, figuring out, what are my matched capital sources? Can I filter down to only non-recourse? Can I look at ones that can go up to this leverage? There's a lot of control and there's a lot of transparency in our portal. And while you still have access to a capital advisor, a lot of that user experience is online, seeing your matched lenders. And we do a lot of small multifamily, it might be your first multifamily deal coming from a residential investment background. It might be that it's your first time going beyond that bank that you have always had your business checking account with, and you need to see who else is out there, especially today. So in 2023, mid 2023, we have banks really pulling back from commercial mortgage lending. There's been some high profile bank failures. Now, it wasn't very commercial real estate and commercial mortgage centric in the beginning. It was Silicon Valley Bank helping all these startups. And, it's getting to be like more skeptical at a banking level nationwide of like, okay, who's holding how much commercial mortgage debt? What types of commercial mortgage debt? What's their exposure? And now the banks are really pulling back from commercial mortgage lending. So it might be that bank you've always had a business relationship with, they're not even going to give you a refinancing option for the commercial property that you've always had with them. And you have to then go look for the banks and credit unions that are still in the game. And so that's really the function that we serve for a lot of small investors today. Here are the banks and credit unions that are still in the game. And the quotes might be really wide. Here's one at 6.5. Here's one at 8.75. The quotes are coming back all over the place right now. So you turn over enough stones where here's who's lending, here's who can close. And, the rates could really be all over the place.
So does the system run personal credit as well? I mean, I know it's all commercial deals. Like, what sort of underwriting does that bank do when you're putting it into the system like this on the individual behind the loan?
Yeah. Well, so that's a good question, because there are 3 legs of any commercial mortgage underwriting. You have the borrower's credit, which is the credit score. But it's not just the credit score. It's the net worth and the liquidity as well, right? And understanding across their portfolio, a portfolio level DSCR, especially today, you're going to need to provide a schedule of real estate owned, And we're going to look and we're going to say, oh, well, you say that property is worth $9 million and, you have a $7 million loan, which is already pretty high leverage. Is your value add working out? What is the debt service coverage ratio trending towards? So from the credit score, yes, like you can kill a deal with credit score. You can't make a deal with credit score, but you can kill it. If it's less than, mid sixes or something, and you don't have a really good explanation for that can kill a deal. But what's going to make a deal on the borrower credit is, hey, is your portfolio level DSCR, is it healthy? And if it refinanced at today's rates, would it still be healthy? So that's a stress test. Your net worth ratio, is your net worth greater than the loan amount? Needs to be today, really. Otherwise, you're probably dealing with some structure. Is your liquidity good for a few months of payments after closing, not just before closing? These are questions that are going to get asked about the borrower's credit today. And then, of course, the other two legs of the stool are the property's finances and, the NOI and where's that trending. And then finally, the third leg is your track record. Have you owned something like this before? If we hand you the keys to this multifamily, do you know what you're doing?
Got it. So as far as, let's say for someone that's never used your platform before and maybe they haven't done a deal like this either, it might be advisable for them to have someone that's actually done the deal so I can come to the table with the liquidity and the track record and the net worth to help fortify that. I mean, and I'm assuming that your platform can accommodate such things too. I'm guessing.
Yeah, it's always a good idea, especially if you're early on in your journey. And really, it doesn't stop there, but especially if you're early on in your journey, it's a good idea to be partnered with somebody that just checks all those boxes. And the boxes really, there are some hard boxes, like they have the net worth greater than 100% of the loan amount. Do they have the liquidity on paper? Those are just check the boxes that are math. The ones that are track record, listen, there's a piece of paper, whether you go through StackSource or you go through a broker, eventually there's going to be a piece of paper that is presented to a credit committee that's never met you. And they're going to have bullet points on that piece of paper. And some of them are going to be, does the math check? Does the math check? Does the math check? Great. And then there's going to be, what is your track record? And there needs to be 1-2 sentences of really strong track record. And you don't want that to be weak. You don't want that to be the weak point on that credit committee memo today. Right. And so partnering is the way through if you don't have it. Don't try to maximize your earnings on the first deal in a new category. If you can maximize your track record, that's going to pay off in the years to come. So I'm a big believer in that. Now, if you get to be a little bit larger and you have the track record as an operator, but now the numbers are really big. Now it's $100 million loan and you as an operator, you have a great track record with these types of properties and you know what you're doing, but you don't have $100 million of net worth to show and the liquidity to flash. Maybe then it is a number thing. And maybe you just need a co-GP partner that you can be paired with that has that. You probably share in some, if it's co-GP, you're probably sharing in some GP economics. What is your acquisition fee? That can be figured out, but sometimes you just need somebody that's a financial sponsor, guarantor, that can unlock that debt for you. And that's nothing to be ashamed of.
Yep. Yeah. It's worth reiterating because new levels bring new devils. And if you've never done a deal before, great. Get someone else to come in. I love what you said. Don't get greedy. There's so many guys that are afraid to give up half of the GP. Give it up. It's fine. Get that first deal done. Go do the next one and keep on growing with that individual. Maybe that individual's got all kinds of net worth and can connect you with even more deals. And it's very short-term thinking. I've heard of folks that get all upset about giving up half of the GP, but it's like if you give up half that GP, you can get so much further along by doing so. Because if you make it that good of a deal for the other person to get in, they will, right? And they'll bring a whole lot of value, right? So,
absolutely.
Yeah, because half of a nothing pie is nothing.
Always. And it's, land, obviously there's not an unlimited amount of land here, but you know what? That's not the constraining factor. You think land is the constraining factor in real estate. You do not realize what game you're in.
Hey, my amazing Bulletproof Cash Flow tribe. Before we dive back in, I want to express my sincerest gratitude for being a part of this community. Your support is what keeps us going strong. If you've been enjoying the information that we've been sharing here, I have a quick favor to ask. Would you mind subscribing to the show and leaving a review on Apple Music? By taking these small steps, you'll help us continue to deliver exceptional content while expanding our reach to fellow investors just like you. Thanks so much for your unwavering support. And now let's dive back in. Right. 100%. So now when that individual goes ahead and completes all that information, let's say they do have a partner to come in on it. Are they just filling out information on a screen and then people bid on it? But I would imagine then the LOI, the letter of intent from the lender, the term sheet, is still contingent on them providing all the backup for it. Is that generally how it's done?
Yeah, there's a lot of due diligence on any sort of commercial real estate deal. And depending on the business plan, different types of due diligence are going to be collected. There's always the borrower stuff. So it's a good idea just to have your schedule of real estate owned and personal financial statements for anybody that presumably will be a guarantor on your deal. Just have them ready because that's going to be needed on every deal. But then depending on, if it's a new construction project, you're going to be talking about feasibility reports. You're going to be talking about zoning. You're going to be talking about entitlements, and all of those are going to be part of the due diligence. If it's just an acquisition, now you become dependent on the seller for, and working with an organized seller. It may not be something that's under your control, but you need to understand that's a contingency to get anything closed. Do they have their accounting in order? Have they kept good records? Do they have a property management company that can prove, what the physical and economic vacancy was 12 months ago, because you're going to need a T12 at close. All this stuff, there's so much due diligence and then of course the third party reports. You can't always control it if it's an acquisition deal, but you can always be prepared with your own personal finances, your portfolio level analytics, and your own pro forma and business plan. And just starting there, you're starting on first base rather than home plate.
Yeah. Well, you know what though? Ignoring the fundamentals to begin with is always a problem. So if you do partner up with that person, just like I said a second ago, if their operations suck, you're gonna be in for a world of hurt. Or if they impose their operations that suck, again, a huge problem, right? So yeah, it's absolutely true that the fundamentals, no matter what deal you're doing, is absolutely key in all these deals. There's that old saying, you don't make your money when you buy the asset, you make the money when you, what is it? No, you don't make your money when you sell the asset, you make the money when you buy the asset.
Yeah.
I think in multifamily, it might be true, but but it might be skewed to how you operate the asset makes all the difference in the world. Because even if you overpay for an asset, if you can operate the hell out of it and still make it very, very profitable, you're going to win. But if you overpay for it and the operations suck, you're going to fail in a big way, and it's going to be a terrible thing. Nothing to do with finance, of course, from your perspective.
Well, unless you get into a floating rate as rates are going up, right? So I think a lot of multifamily investors that got into fixed rates 2 years ago, they probably don't want to sell no matter what's happened to their NOI right now. Because, if you got in with 3% debt, 3.5% debt, it kind of feels like letting go is losing something, even if it's the right purchase price right now. I think we've seen that already. Multifamily investment sales has been way down in the first half of 2023. And there's been the interest rate volatility, and that's been part of it. But just, having debt at 3.5%, if it's not assumable or, it's a low LTV right now, it's hard to justify being a seller right now for many multifamily investors. I think the data has shown that.
Yeah. Oh, no. Actually, you bring about a good point. Right now, there's also those guys that did get a floating rate and they never got a rate cap. Think of a rate cap, guys. For those who don't know, a rate cap is almost like an insurance policy against the rate going up tremendously quickly. And a lot of folks didn't buy that rate cap. So next thing you know, when it was at a 3%, everybody's laughing all the way to the bank. But now the same loan is now 8-9% in some cases. Ridiculous. And they're caught between a rock and a hard place. They don't even know what to do at this point. Like they're having to dump the deal just to get out of it.
Yeah,
right? You finding some of that stuff happening as well.
We've seen everything from people trying to assume assumable mortgage. So there's a class of commercial mortgages that are assumable, right? So theoretically, the agency finance, loan options, Fannie Mae, Freddie Mac, and HUD are theoretically all assumable. Now, the new borrower has to qualify, and there's some other qualifiers on that. CMBS is theoretically assumable. So we've seen assumptions. We've seen on both sides lenders that are stuck in a fixed rate loan, wishing that it was floating and offering cash to borrowers to let the interest rate go up. And that's an interesting non-refi kind of pseudo cash out refi option that we've seen some borrowers consider from their lenders. And then we've seen, the same thing from borrowers offering to lenders that they want to pay down their rate because they missed that opportunity. There's all sorts of interesting negotiations going on with debt right now. We've seen for the last about 15 months just a rise of commercial mortgage rates. It's kind of plateauing right now, but there may be still a little bit more to go in the second half of the year. It's completely different than where we were birthed in 2017, 2018, where rates were low for years. They stayed low for another few years. So it's been quite it's been interesting to watch all the different negotiations that have gone on for these debt deals.
It's funny when I heard that term a long time ago, when the money was free, and you don't really have a perspective, and nor do you think it's ever going to end, right? And what I mean by free, it's like 3.5%. 2.9%. Remember all those days? It wasn't that long ago, right? Now it's more the norm, unfortunately. But it really is crazy, crazy times. I think what makes it more crazy is how fast it occurred, how quickly the rates have jumped up. And I think it's going to cause a whole lot of stress for many people out there. And I think it also presents an opportunity for people to start buying assets at the right price where it makes sense.
Yes.
With the right debt and the right equity and everything else like that. I mean, there's going to be a lot of deals hitting the market here. I can certainly see it, because there's just a whole lot of stress on many, many deals out there, many of them. But what's your take on that?
If you're in a market where rents are no longer rising, maybe they were falling, you may be holding on to dear life for something that you acquired 18 months ago. It's been, I think according to Green Street, multifamily specifically, property values have been down about 9% in the last 12 months. And there are exceptions to that. It depends where you bought and what you did. There's a gap between buyers and sellers right now on price expectations. Sellers are, hoping for last month's price, and buyers are hoping for next month's price. I think a lot of equity has been on the sidelines for that reason, and that's why we haven't seen so many trades yet this year, all things considered. There are always opportunities for creative investors, right? If you have creative financing, if you have a creative business plan, it's adaptive reuse. We financed some office to multifamily conversions this year so far. There are always opportunities for creative investors. If you're not creative and you bought in the wrong market, and now that market's rent has stalled or even fallen and your expenses are still going up because there's inflation, that's where people are really in trouble. There's always room for the creative investor. If all you're doing is buying cap rate multifamily, the timing hasn't been there. Sorry, you've probably lost money. You might have lost your equity. If all you're doing is buying cap rate stabilized multifamily, without off-market access, those have been the ones that have been the losers of the last year and a half. But there's always room for the creative folks.
Yeah, 100%. Well, we've covered a lot of stuff here today. I know there's a whole lot of movement in the market, a whole lot of people thinking about getting into the whole multifamily game. What sort of bulletproof advice do you have for those people that might be trying to find the right debt for the deals they might be looking at?
Yeah, I think I'm going to go back, Agostino, to this. The reference checks should be both ways. If you have a due diligence, if you see a good term sheet in front of you, and there's about to be a due diligence where they're going to ask you for so much documentation, and depending on the type of loan or financing you're going for, there's going to be a whole lot of documentation. Write your own very simple due diligence list of your capital provider, and that can be sent to a lender. It could also be sent to an equity provider. If you're not sure how to write that list or what questions should be on it, that's where a more experienced investor or a capital advisor can advise on this. But it's fair, and you should write your own due diligence list backed on them. And it can include references from other borrowers, especially, other borrowers that they've written bridge loans to. And, how have they treated people that, have had some time of lease up and gone through these similar transactions? You can ask for references from other borrowers. You can ask your own due diligence questions. So that's my one bulletproof piece of advice: is have your own due diligence list, not only for the property, but for your capital partners.
Love it. Love it. Yeah. And I'm a real big believer. If you're going to do multifamily deals, always find a capital partner, a broker to help accommodate and shepherd the deal properly, because guys like the ones that you have will go out and bust their chops to find the right debt, the right solution for the deal that you're presenting. If you try to do this on your own, it's going to cost you a lot of time, headache, and money. And where guys like you and your team, they already know where to get it. Pay the extra money, get it done properly.
Staying away from the wrong lender is like one of the things that can save you a lot of time and heartbreak.
Yeah. Hey, listen, guys, if 1% is going to kill the deal, you have a crappy deal on your hands anyway. All right. Simple as that. It's true. It's true. All right, guys. Well, if you want to reach out to Tim, you can reach him via his website at StackSource.com. Hope you got some insight on how to find debt given today's market times right now. There's a whole lot of turbulence. So finding the right debt makes all the sense in the world. Check out StackSource. We're currently using them on a couple deals here, and they're great people. They really are. Thanks for tuning in. See you next episode. Take care. Having a blast? Listen, if real estate's your thing, don't miss out. I have plenty of free resources on the bulletproofcashflow.com website, as well as masterminds you can take part in to help elevate your game. Go ahead and check it out.
You've been listening to the Bulletproof Cashflow Show. We hope you've enjoyed the show. We know we had fun. Make sure to visit our Apple Podcast page and leave us a 5-star review. We hope you've gotten some useful and practical information from the show. For real estate coaching, events, and resources, hit up bulletproofcashflow.com. Till next time.
No information in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this show are limited to accredited or sophisticated investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice.